You've got your money saved and are ready to invest, but you need guidance through the myriad of options available. So you seek out a financial advisor. But do they truly have your best interests in mind? The reality is that this isn't always the case. Think about this: every year, a significant portion of Americans hire a financial advisor. That's over 20 million people trusting someone else with their hard-earned money. But here's the kicker: only half of those advisors are legally bound to put your interests first through fiduciary standards. The rest might be more focused on making commissions under suitability standards. So how do you know who's legit and who is? It all comes down to professional standards and a term called fiduciary duty. A fiduciary is obligated to act in your best interest at all times, like a financial superhero for your money. However, not every advisor is legally required to be a fiduciary. Let's dive into the details. Subject: Professional standards for financial advisors. Passage to fact check. First up, how do you even find a financial advisor? There are three main types: brokers, investment advisors, RIAs, and fee-only planners. Each has its own set of rules and incentives, so it's crucial to know what you're getting into. Brokers typically earn commissions based on the products they sell, while RIAs are held to a fiduciary standard requiring them to act in their clients' best interests at all times. Fee-only planners charge for their services exclusively through fees paid by clients, and do not receive any compensation from product sales or other third parties. Brokers are like salespeople for financial products and get paid based on the products they sell you. So if a broker recommends a particular mutual fund or stock, that fund might pay them a commission through payment for order flow or other arrangements. It's not that brokers are bad; they can offer valuable advice, but their incentives aren't always aligned with your interests. Investment advisors might seem like they are working for you, but here's the catch: most of them are registered representatives who follow something called suitability. This means they only need to recommend products that reasonably suit your needs. However, there is an exception. If an investment advisor has a fiduciary duty, then they legally must act in your best interest at all times. Fee-only planners are the good guys here. They get paid directly by you, rather than through commissions from financial products they recommend. So when they provide advice, it is purely based on what's best for you without any hidden agendas. It's like hiring a personal trainer who gets paid regardless of whether you purchase new equipment or not. There are no conflicts between their recommendations and your goals. Now let's talk about the nuts and bolts of fiduciary duty. Here's where things get tricky. While many financial advisors are not legally required to be fiduciaries by default, they can choose to adhere to fiduciary standards voluntarily. This means adhering to a higher ethical standard that prioritizes clients' best interests over their own or their firm's profit motives. It involves more rigorous standards and additional paperwork, but the client benefits from clear transparency and accountability. Here's a concrete example. Imagine you have $100,000 in your retirement account. A non-fiduciary advisor might recommend an investment with high fees because of the commission they'll earn. But a fiduciary would prioritize low-cost index funds that can offer better long-term results due to lower expense ratios and more efficient tracking of market returns. It's like choosing between a fancy car that consumes all your fuel money versus a reliable sedan that helps you save on gas. The catch: not every advisor is upfront about whether they operate as a fiduciary or not. So how do you find out? Simply ask them directly if they have a legal obligation to act in your best interest at all times. If they hesitate, consider looking elsewhere. A good financial advisor should be transparent and clear about their role. Now let's look at some real-world implications of this. Take the 2008 financial crisis as an example. Many investors experienced significant losses because their advisors often recommended risky investments without fully disclosing all associated risks. If more advisors had been required to act as fiduciaries back then, providing a higher standard of care and full disclosure, fewer people might have ended up in financial distress. But here's a shocking fact. Even today, only about half of all financial professionals are legally required to act as fiduciaries when providing investment advice. That means 50% of the time, you could be working with someone who may not have your best interest at heart. The rest operate under suitability standards, which require them to recommend investments that are suitable for clients, but do not necessarily ensure they are acting in their clients' best interests. Now let's talk numbers. Let's say an advisor recommends a mutual fund with annual fees of 1%. It might sound small, but over time, those fees can significantly impact your returns. Take $50,000 invested for 30 years. If the market grows by 7% annually, you'd end up with about $284,000 after paying a 1% fee versus nearly $409,000 without any fees. That's a difference of over $125,000, roughly 3 years' salary for the average American according to the Bureau of Labor Statistics. Here's another angle. Think about how your brain works when it comes to money. You're wired to chase quick wins and avoid losses. This can lead you down the path of risky investments or high-fee products that look promising but end up costing more in the long run. A fiduciary advisor understands these psychological traps and guides you towards more stable, long-term financial strategies. A safer, smarter path. But here's a crucial tip: don't just trust promises. Look for certifications like Certified Financial Planner, CFP, or Chartered Financial Consultant, CHFC. These professionals have completed rigorous training and adhere to higher standards of ethics and client care. They are more likely, though not guaranteed, to act as fiduciaries. And remember, a good advisor doesn't just sell you products, they educate you about your finances. They'll help you understand concepts like compound interest, tax benefits, and the long-term effects of fees. You should leave each meeting feeling like you've gained knowledge, not just with another financial product. Here's one final myth to shatter. Finding a fiduciary advisor is not as difficult as it seems, and it's worth the effort. Start by asking for referrals from friends or family who have had positive experiences. Websites like NAPFA, National Association of Personal Financial Advisors, and CFP Board also provide searchable directories with vetted professionals. So here's the bottom line. When you choose a financial advisor, ensure they are held to a fiduciary standard, meaning they must act in your best interest at all times. This legal requirement could significantly enhance your financial outcomes over your lifetime. A little extra due diligence now can prevent major headaches later. This is educational and historical, not financial advice. When meeting with a potential financial advisor, inquire about their process for identifying and addressing conflicts of interest. Transparency in this area is crucial because some advisors may have incentives to recommend certain products or services that might not be in your best interest. For example, an advisor who receives kickbacks from insurance companies might encourage you to purchase policies they earn more from, even if a simpler term policy would better suit your needs. Another key area to explore is how the advisor gets paid. There are two primary ways: fee-only and commission-based. Fee-only advisors charge a percentage of your assets or an hourly rate for their services, while commission-based advisors receive payments based on the products they sell. Fee-only advisors tend to have fewer conflicts of interest because their income isn't tied directly to selling specific financial products. To find a reputable advisor, look for certifications like CFP Registered Certified Financial Planner, CRPCTM Chartered Retirement Planning Counselor, or RIA Registered Investment Advisor. The CFP Registered designation requires rigorous testing and continuing education through the Certified Financial Planner Board of Standards, while the CRPCTM credential is offered by the College for Financial Planning. RIAs are required to register with either the SEC, Securities and Exchange Commission, or state securities regulators under certain conditions. Additionally, you can check if they're licensed by FINRA, Financial Industry Regulatory Authority, and have a clean disciplinary record through regulatory databases like FINRA's BrokerCheck. During your initial consultation, bring up the topic of investment fees. High-cost mutual funds or actively managed accounts might seem appealing because they promise higher returns, but often their performance doesn't justify the extra expense due to higher management fees and expenses. Index funds, on the other hand, typically offer lower fees with comparable or even better long-term returns, thanks to lower operating costs and more consistent performance relative to market indices. It's also wise to ask about the advisor's experience and expertise in areas relevant to your financial goals. If you're nearing retirement, for example, ensure that they have a specialization in retirement planning rather than just general wealth management. A good advisor will tailor their advice to meet your specific needs and circumstances, but remember this is educational information and not personalized financial advice. Remember that a strong relationship with your financial advisor is built on trust and open communication. Don't hesitate to ask detailed questions about investment strategies or fee structures during meetings. You may take notes or, with the advisor's permission, record the session for later review. A professional who respects your concerns will welcome this level of engagement. Lastly, consider the advisor's track record. While past performance isn't a guarantee of future results, it can offer valuable insight into their approach and decision-making process. Many financial advisors provide case studies or client testimonials on their websites that highlight successful outcomes. Use these resources to gauge whether they have a history of helping clients achieve their goals in line with industry standards and ethical practices. In summary, selecting the right financial advisor is crucial for safeguarding your financial future. By asking pointed questions about their fiduciary status, payment structure, certifications, and expertise, you can ensure you're working with someone dedicated to your best interests. This due diligence might take extra time up front, but it's an investment that pays off in peace of mind and potentially better long-term outcomes. This is educational and historical, not financial advice. When evaluating a financial advisor, consider their professional reputation and track record. Check if they have been involved in any regulatory actions or received complaints from past clients. Websites like FINRA's BrokerCheck can provide this information for free. A clean record reflects well on an advisor's integrity. Another key aspect is the advisor's ongoing education. The financial industry evolves rapidly, with new products and regulatory changes constantly emerging. An advisor who stays current through continuing education demonstrates a commitment to staying informed and providing clients with up-to-date information and guidance. Consider how the advisor communicates with clients. Do they provide regular updates and keep you informed about your investments? Transparency is crucial here. A good financial advisor should be accessible, responsive, and willing to answer all your questions clearly and thoroughly, without providing personalized investment advice. Lastly, think about the advisor's overall philosophy and approach. Some advisors are more hands-on, regularly adjusting portfolios, while others take a passive role, focusing on long-term investment strategies with minimal intervention. If you prefer active management of your portfolio with regular adjustments, find an advisor who shares this preference for frequent portfolio rebalancing. On the other hand, if you're comfortable with a set-it-and-forget-it strategy, look for someone who specializes in long-term investments and minimal intervention, typically associated with passive investment approaches like index funds. By carefully vetting these aspects, you will be better equipped to choose a financial advisor who aligns with your values and goals. This attention to detail can help protect you from costly mistakes and ensure that your financial journey is guided by a trustworthy professional. This is educational and historical, not financial advice.